9 gas station chains, thousands of locations, and the next time you pull off the highway to fill up, there is a real chance the station you are counting on is already gone. America has over 150,000 convenience stores. For decades, that number climbed every year. Fuel margins were thin but reliable. Tobacco and snack sales covered the rest. It was one of the most consistent businesses in the country. In 2026, that model is breaking apart, and the chains disappearing from America's roadsides range from names you have never heard of to one you have been visiting your entire life. Here is the problem with gas stations that most people never think about. The fuel itself barely makes money. A gallon of gas might generate a few cents of margin for the station owner, sometimes less. The real money was always inside the store. Cigarettes, energy drinks, lottery tickets, fountain drinks. That is where the profit was. Now every one of those categories is under pressure. Cigarette sales have dropped 26% since 2019. Energy drink competition has fractured the category. Customers who used to walk in for a Slurpee and a pack of cigarettes are now ordering delivery or skipping the stop entirely. Add rising labor costs, aging equipment that needs expensive upgrades, environmental regulations that mandate tank replacements costing hundreds of thousands of dollars, and electric vehicles that don't stop for gas at all. The math that made a convenience store viable for 3 decades no longer works. What you are seeing in 2026 is not a blip. It is a reckoning that has been building for years, and the smallest operators are disappearing fastest. But as you will see, even the biggest names are not immune. Number 9. Mega Co-op. 31 locations across the Midwest, all of them permanently closed. The chain filed for Chapter 11 bankruptcy in September of 2023, tried to restructure by closing 13 stores and launching a recovery plan, emerged from bankruptcy in June of 2024, and then failed anyway. Mega Co-op was founded as a cooperative to provide affordable fuel and convenience services to communities that needed them. It had solid growth before the pandemic, but the health crisis hit, inflation followed, and consumer habits shifted in ways the cooperative model could not absorb. Chief Executive Mike Buck cited shrinking fuel margins and persistent cash flow problems as the determining factors. The company broke its franchise alliance with Holiday Station stores in an attempt to cut costs. It was not enough. What makes Mega Co-op significant is not its size, it is the pattern. A chain files bankruptcy, it restructures, it closes the weakest locations, it emerges with a plan. Then the underlying economics catch up again, because restructuring changes the debt load, not the fuel margin. And the fuel margin is the problem. 31 stores, gone, their website offline, their communities left to find alternatives that in some rural areas require a meaningful drive. Number 8. The Store, operated by Team Schierl companies. 25 locations across Michigan and Wisconsin, all of them shut down on July 31, 2024. Not because the store failed, because their landlord failed first. This is one of the stranger collapse stories in recent convenience store history. The store had sold the land and buildings of its locations to Mountain Express Oil Company in 2022, then continued operating the stores as a tenant. When Mountain Express filed Chapter 7 bankruptcy liquidation in August of 2023, the store lost its real estate foundation overnight. 25 stores, hundreds of employees, communities across 2 states, all shut down because of a landlord bankruptcy they had no control over. The vulnerability here is structural. When convenience store operators sell and lease back their real estate to generate capital, they trade long-term stability for short-term flexibility. It works fine until the landlord disappears, and in 2023 and 2024, landlords started disappearing. Number 7. Mountain Express Oil. This is the landlord from the previous story, and its collapse was far larger than what it did to the store. Mountain Express was founded in 2000 in Alpharetta, Georgia. By its peak, it distributed fuel to 828 fueling centers and 27 travel centers across 27 states. It had become one of the largest fuel distribution and convenience store operators in the country that most Americans had never heard of. It filed Chapter 7 bankruptcy liquidation in August of 2023, not Chapter 11 reorganization. Chapter 7, liquidation. That means no restructuring, no second chance, no recovery plan. The company simply stopped existing. 828 fueling centers, 27 states. The ripple effect spread through every landlord-tenant relationship the company had built, taking down operators like the store who had structured their businesses around Mountain Express's continued existence. The story of Mountain Express is a warning about the hidden concentration risk inside the convenience store industry. When a fuel distribution giant disappears without warning, it does not just take itself down, it takes everyone in its orbit. Number 6. SQRL Service Stations. Chapter 7, liquidation, over $1.2 billion in unsecured debt. 406 gas station leases across the United States, all of it worthless. SQRL was purchased by Gas Hub Investments in April of 2024 for $17 million. Within days of completing the acquisition, SQRL began breaching its leases by failing to pay rent. The bankruptcy trustee later summarized the situation in court documents with devastating directness. The bankruptcy estate has no bank account, no income, and its assets, primarily the scheduled leases for 406 gas stations, are of questionable value. Gas Hub had paid $17 million for a company that, as soon as they owned it, they could no longer afford to operate. The Chapter 11 case was converted to Chapter 7 in November of 2024. There was no recovery, no buyer, no future, just 406 empty leases across Arkansas, Florida, Oklahoma, Texas, and beyond. Number 5. Schierl. Schierl is not going bankrupt. Schierl is not struggling. Schierl is one of the largest energy companies on the planet, and it is deliberately walking away from retail gas stations at a rate of 500 locations per year. Beginning in 2024, Schierl announced plans to divest approximately 500 company-owned retail sites annually as part of what it called an upgrade of its retail network. The reality is that Schierl has decided that directly operating retail gas stations is no longer worth the trouble. The margins are too thin, the labor costs are too high, the capital requirements for modernization and EV infrastructure are too steep, and the long-term trajectory of a business built on selling gasoline to internal combustion engines has become difficult to justify to shareholders. When a company the size of Schierl decides that retail gas stations are not a business it wants to be in anymore, that is a structural signal about the entire category. 500 locations per year, divested or closed year after year. Number 4. BP. The same story, told by a different oil major. BP has been systematically exiting direct retail operations across North America, following a strategy that mirrors Shell's almost exactly. The oil company wants to sell fuel. It no longer wants to own the stations that sell it. Thin retail margins, regulatory pressure, decarbonization commitments, and shifting consumer patterns have made direct retail ownership a liability rather than an asset. When both Shell and BP, two of the 5 largest oil companies in the world, are actively reducing their retail footprints at the same time, it means something has changed permanently about the economics of the American gas station. The question is not whether the category will shrink, it is how fast. Before we get to the top 3, consider what we have covered. 2 chains that collapsed entirely, one that took down its tenant with it, one whose new owner failed in weeks, and 2 of the world's largest energy companies voluntarily walking away from retail. Every one of these stories points to the same underlying reality. The traditional American gas station, cheap fuel, cigarettes, and a fountain drink, is no longer a viable business model in enough markets to sustain the network that was built around it. The top 3 are the stories that will define what the American roadside looks like in 5 years. Number 3. EG America and Cumberland Farms. EG America is the United States arm of EG Group, a British convenience and fuel retail operator. In America, it operates under brands including Cumberland Farms, which has been a New England institution for decades, along with Fastlane, Certified Oil, Tom Thumb, and others. EG Group expanded aggressively through acquisitions, purchasing Cumberland Farms in 2019 and adding additional brands in subsequent years. The parent company built a significant debt load in the process. That debt has become a persistent problem. EG Group's financial structure carries obligations that require the underlying retail business to perform at levels the convenience store category is not currently delivering. Shrinking tobacco margins, rising wages, and softer fuel volumes have all contributed to a performance gap between what the business needs to earn and what it is actually generating. Cumberland Farms, the brand most recognizable to New England consumers, represents something more than a financial story. For generations of residents across Connecticut, Massachusetts, and neighboring states, Cumberland Farms was the neighborhood gas station, the convenience store that was always open. The idea that the company behind it is under serious financial pressure and that its parent's debt structure may force decisions that no amount of brand loyalty can prevent is a story that has not yet fully arrived, but it is coming. Number 2, Pilot Flying J, the largest truck stop and travel center operator in the United States. More than 800 locations, and a company whose recent history is as complicated as its financial present. The fraud case against Pilot Flying J, in which the company admitted to cheating trucking customers out of fuel rebates, resulted in a Department of Justice settlement and years of reputational damage. The legal and operational disruptions ran deep. Beyond the legal history, Pilot Flying J faces the same structural challenge as every fuel retailer. The customer it was built to serve is changing. Long-haul truckers are increasingly under pressure from electrification mandates on commercial vehicles in key states. The infrastructure transition for heavy trucking will take decades, but the investment requirements it creates in the present are significant. Pilot Flying J is not collapsing, but a company that controls the roadside fuel experience for American trucking, that carries the reputational weight of a major federal fraud case, and that must now navigate a forced transition toward EV infrastructure it did not build its model around, is a company under more pressure than its size suggests. Number 1, 7-Eleven, 645 stores closing in fiscal year 2026 alone. The fifth consecutive year that closures have outnumbered openings. A store count projected to fall from over 13,000 North American locations to approximately 12,272 by the end of the year. 7-Eleven is the most recognizable convenience store brand in the world. It is 99 years old. It invented the category. The Slurpee, the Big Gulp, the hot dog roller, the early morning coffee, all of it synonymous with an American roadside experience that has been part of the country's daily life for longer than most people alive can remember. And it is closing 645 stores this year. Its Japanese parent company, 7&i Holdings, has delayed a planned IPO of the North American business from 2026 to 2027 at the earliest, citing the need to cut costs and turn around performance. Customer traffic has declined. Tobacco sales, historically a margin anchor for the entire category, have dropped sharply. The transformation plan the company launched, including Japanese-inspired food offerings and an expanded delivery service, has not yet moved the fundamental numbers. Some of the 645 closures will convert to wholesale fuel operations, meaning the gas pumps stay but the store goes dark. Others will simply close. In either case, the footprint of the world's most iconic convenience store chain is shrinking in America for the fifth year in a row. If 7-Eleven cannot figure out what the American convenience store is supposed to be in 2026, it is not clear who can. 9 chains, thousands of locations, and a category that once seemed as permanent as the highway itself is being asked a question it has never had to answer before. What exactly is a gas station for, in a world where the next generation of vehicles does not need gas? The answer is coming slowly and painfully, and through closures and bankruptcies and divestitures that are being announced quietly enough that most Americans do not notice until the station they have been stopping at for 20 years has a for lease sign in the window. Electric vehicles now represent a growing percentage of new car sales. Commercial vehicle electrification is advancing on a regulatory timeline that the trucking industry did not choose. The cigarette customer is aging out of the market, and the convenience store industry's response, better food, faster delivery, loyalty apps, has not yet proven it can replace the revenue those trends are removing. Tomorrow, we are looking at a category where the closures are happening inside buildings you walk into every week: grocery chains. And the names on that list will be even more familiar than the ones you heard today. Subscribe before that video drops, because the American supply chain for your daily life is changing faster than the headlines suggest.